I was trying to record. Okay, so basically, we are looking into houses. We went and saw one today. One was for sale for 75, but went down to 65 stacks. Can you help with any advice on how to get a home or a loan? What to expect with this being my first time? I plan to apply through my credit union, but don't know what I'm doing. So, what are your suggestions?
Okay,
Should she start with her credit first?
definitely. The credit needs to be the middle score. And what we mean by the middle score is when you look at all three of your scores, one will be the highest, one will be the lowest, and that one that's in the middle is the one that the bank will look at. That middle score needs to be at least a 620 to get a good rate. Some banks will let you have the middle score at 580, but the rate won't be that good. But if you can get your middle score to a 620 or higher, then that'll be the credit part situated. Next thing you want to look at is that most bank programs require you to have at least 5% down. Now, if you calculate 5% on the 65 price, that comes to, let's see, 65K, 5%. That'll be $3,250. So at the minimum, you need to have at least $3,250 to put down at closing. Now, all closing is just basically you would basically go to whoever has this house, because you don't buy a house and you get the house the next day. It don't work like that. A house is bought between at least the first day up until 30 days. Sometimes it take about 30 days to close on a house, depending on who has the house. Now, if you're getting funding, then it'll probably take the full 30 days. Sometimes it can take a little more. If you had cash, if you had the 65K cash, then you could be in a better position to negotiate or pay cash and get the house pretty much immediately. You still would have to go to closing, which is basically closing. All closing is going to a title company, taking the money or the funds there to sign the paperwork, because that paperwork is almost like a big notebook. It's about 100 and some pages. You signing all these pages, and they'll talk you through everything that's on the pages. It ain't no biggie. So, like I said, the second thing is to have your 5% at minimum. If you're able to acquire 20% down, then you can skip what is called the mortgage insurance. And that mortgage insurance is usually somewhere about $60 to $100, somewhere in there, depending on how much the house costs. Now, this house being at about 65, you're probably looking at only about the low end, $60, or it could even be a little bit less for mortgage insurance. But when you look at that cost over 30 years, you kind of want to avoid that if you could, but you may not have 20% to put down. So the next thing would be is depending on your job. If you have a job that gives you a W-2 from the company, then the bank is going to look at 2 years of your W-2s, basically 2 years of your income tax, to see how much you made. You have to make a certain amount to qualify for that house. At 65K, you don't have to really make that much. You probably can make about 25 grand, somewhere about 25 grand a year, and be good. So you want to make sure that you have 2 years of income tax statements that show that you've made money. If you are your own business and you want to be in a position where you have been paying yourself for 2 years so you can show that income tax statement. If not, then they may require you to show them your business bank account statements your business bank account income tax 2 years back. So you probably can use that. Really, the credit and showing what your income is the two biggest things that would, keep you from really getting a house. That's just really the two big things. Credit and income. So if both of those are in line, then shoot, you good to go. Of course, you need the down payment. That's another thing. I guess you could say it's 3. But other than that, that's really all it is to getting a house. As far as getting insurance, you'll have to get insurance on the house, but that'll all be tied into your payments. So there's no biggie there, really. I think that's about it.
Okay.
One of the things I did is did a calculation because we don't know how much the house is worth. There's one other factor. Banks will pay up to 80% of the loan value. So depending on how much the house is actually worth, they will pay up to 80% of that amount based on what the house is valued at. So if this house if the house is not worth 65, then you'll have to do a calculation on what it is worth and do 80% of that, and the bank will loan up to that amount, which means you would have to cover the rest. So in this situation, if the house is only worth $65K, then they're only going to pay $47,000. They'll only loan you the $47,000, which means you would have to come up with the $13,000. That's what makes up the other 20%. But those numbers, you just have to really know what the house is worth. So you would need to either have it appraised, or you have to do some research online to see what the house is averaging out, what the comps are saying that it's worth. So just another factor to put into the mix.